Okay, so this is part two of the introductory lecture to Auditing 3A. In this part of the lecture, we're going to be talking about the different types of people that are involved in the auditing process. We will also be dealing with assertions, which is critically important for understanding the rest of the year. So we have to pay careful attention to the assertions. Okay, let's get straight into it. So, there are three people, as mentioned previously by the auditing triangle. There are three people that are involved in the auditing relationship. The first is the shareholders. Right, so the shareholders have been appointed. The shareholders are the owners of the business. They have put in their capital into the business. They are the ones that will appoint the directors to manage the business and also appoint the auditor, external auditor, to audit the financial statements. They are the intended users of the financial statements at the end. So they are critical role players in the audit scheme of things. The next are the directors. So directors are actually management. They are responsible for day-to-day management. They are responsible for strategy. They are responsible for taking care of the assets in the business, for using the assets in the business in a way that benefits the shareholders, um, and they also are responsible for the preparation, the presentation, accurate presentation of the financial statements. Um, then the auditor, which is the one we want to focus in on. So the auditors are uh, people that, as we said before, are independent of the company. They are also people that come in and they give an opinion about the financial statements, and that opinion is then used to help with credibility of the financial statements. Um, you find that their opinion is contained in a thing called an audit report, right? So the opinion is in the audit report, and the audit report is then sent out to not only shareholders but stakeholders, so everyone that's involved in the company. Now, I want to just look a little bit about at the legislation, right? So we have this legislation called the Companies Act. In the Companies Act, we showed how to create a company, we are showed how to administer a company, we are showed how to run a company to a certain extent, so for the fiduciary benefit of the shareholders. But they also touch on when a company should be audited. They tell you when it is compulsory for a company should be audited. They indicate when you can have an independent review, when you can go for voluntary audit, um, and like we spoke about just now about the public interest score, we can look at the different markers that the companies that indicate. So, for example, turnover, third-party debt, those types of things. We can look at those markers and then determine if a company is a public company or private company, and then does it need to be audited or not. The Companies Act also assists us with the appointment, actions, um, and behavior of both the directors as well as the external auditors. So it helps us to identify which is good behavior and which is bad behavior. The next is the Auditing Professions Act. Now, the Auditing Professions Act is made particularly for auditors. It is the act that creates IRBA, right? So we heard about IRBA a little bit earlier on in part one. And so it's the act that creates IRBA, the regulator. It tells the auditor when the auditor has crossed the line, so when the auditor is liable. It tells the auditor how and how not to act. It indicates to the auditor the rules and regulations around auditing in South Africa. It is an important part of legislation, um, but both parts of legislation that we've looked at today, so both the Companies Act and the Auditing Professions Act, will only be considered in detail in the second semester. That does not mean that you don't need to focus on this part of the course, because it's all interlinked, right? So both first and second semester all interlinked, and so you should know these basic points about the Auditing Professions Act in order for you to cope with the rest of the semester. The next part of legislation that I want to look at is the International Standards on Auditing. Now, we're not going to spend a lot of time on it, and the reason why is because basically the rest of the course is based on the International Standards of Auditing. All you need to know now at a basic level is that there are standards of how an auditor should perform an audit. It also gives us techniques, best practice techniques, as well as what not to do and how we can be punished. Sometimes it indicates how we can be punished if we don't follow the standards, right? Now, this is very important. So, assertions. What are assertions? Assertions come from the word assert. To assert something is to proclaim or to say something, right? In that way, the assertions of financial statements is when management says something about the financial statements. Now, as a given, right, so it is assumed that management says certain things about financial statements. For example, management says that all the assets that are recorded on the financial statements actually exist. So they are trying to say, or they are asserting, that there are no fake assets. Okay? Management, and if you look at that type of assertion, what the assertion they're trying to get at is the assertion of existence. So let's now look at the assertion of occurrence in revenue. So management is saying all the sales have occurred validly. It's a valid sale, right? There's a valid occurrence of a sale. That is what they are asserting, okay? And that leads us to the assertion of occurrence. Okay. Now, you've got to understand that in accounting there are two types of accounts. There are what we call transactional accounts, and then there are balance accounts. Transactional accounts are accounts that at the end of the year are zeroed out, they become null. They are often referred to as income statement accounts. Okay, so at the end of the year, income statement is zeroed out. It's displayed and then it starts the new year on zero. Those are called transactional accounts. They are only in existence for one financial period. Okay, so let's list some transactional accounts. We've got revenue is a transactional account. It's only in existence for one financial period. The next year it starts again on zero. So revenue. We've got all expenses are transactional accounts. Okay, things like interest expense, administration expense, cost of sales, those are all transactional accounts. They're only in existence for 1 year. Then we've got balances. Balances are accounts that roll over from year to year. Okay, so let's talk about some types of balances. Debtors. This current year debtors are added on to the total at the end of the previous year. Right? And then whichever debtors have paid are then minused from that total. So balances are accounts that roll over from year to year. They are not zeroed out at the end of the year. Instead, they keep a record of something. It's a cumulative balance. Okay? It's a cumulative balance. So there's two types of there's two types of accounts: transactional accounts and balance accounts. When we work with assertions in auditing, we actually split the accounts into those two types. So we split them into transactional and we split them into balance. So first, let's look at transactional accounts. Okay. Now, don't be confused. Transactional accounts that increase on the debit side are called expenses. Transactional accounts that increase on the debit side are called expenses. Okay? And the most important assertions that we need to think about when dealing with expenses are completeness. What does completeness mean? Completeness means all the events or all the transactions in a given year have been included in this transactional account. Okay? All the transactions, if we're dealing with cost of sales, all the cost of sales in a given year have been included in the cost of sales account. Okay, then we have accuracy. Accuracy means that all the transactions that are recorded here are accurately, the figures, the numbers, the rands are accurately recorded. Cutoff. Cutoff says that we have demarcated or broken up the financial period in the correct way. We have not waited too long. So cutoff is asking the question, has everything that is supposed to be in this year been included in this year, and are there any transactions in next year that should be included, right? Or are there any transactions in this year that should be included in next year? So they're asking about that stopping period. When did you stop recording? Okay, that's cutoff. Then we've got the assertion of occurrence. Now, with transactions, all balances that increase on the credit side of the account are called income accounts. So revenue is an income account. It increases on the credit side of the account, right? And the assertions that we are worried about or that are most popular are, for example, occurrence. Now, what does occurrence say? Occurrence says, has a transaction validly occurred? Has it validly happened? Okay, that's what occurrence is asking. Has it taken place? Cutoff we've spoken about, and accuracy we've spoken about. In all transactions, we always have three assertions that are always present. The first is classification. Right? Classification is asking the question of, has this account been correctly allocated? Or has a transaction been correctly allocated? What does that mean? It means if we have an expense, have we put the expense into the expense account, or have we debited it to debtors? Because we know that we can't debit an expense to debtors, because that's not where it goes. It must go into expenses account. So that's what classification is asking. Have we put it in the correct classification? Have we classified it as an expense? Presentation and disclosure is about the financial statements, right? Have we accurately disclosed every figure at an appropriate level? So what you'll find is certain figures need to be more detailed, while others can be less detailed. This is asking, have we accurately disclosed it at an appropriate level? Now, all of these assertions are applicable to both expenses and income. But I have split them up in this way because I want you to see which are the most important assertions when it comes to transactional accounts. Okay? Let's move on to balance accounts. So balance accounts, there are two types of accounts. Accounts that increase on the debit side are called assets. Accounts that increase on the credit side are called liabilities. When we're talking about assets, we are worried about whether the asset actually exists. Is there really an asset? Is there really, because remember what asset is value. So you're asking, does the value really exist? Okay, so that's what's asking. That's what it's all about. Does the value really exist? Okay, then we move on to accuracy. Accuracy again is saying that the rands and cents are correctly allocated to the account, correctly recorded in the account. Valuation is saying, have we given this asset, this amount of value, have we given it the correct rand amount? Okay, and that is, valuations only comes about because with assets and liabilities, there are lots of judgment calls in determining the value. So, for example, when we're dealing with debtors, we often have this thing called a bad debt provision. That is a judgmental number, and as a result, we need to look at valuation to see whether that number has been overstated or understated. And then rights. Rights and obligations go together. Rights talks to, do I own something? Right? That, do I have the right to it? Do I own it? And then obligation is asking, do I owe someone? Am I owing money? Okay. So those are the two also that come in. So rights and obligations, do I hold or control something? Valuation and allocation, have the amounts been correctly allocated to the correct asset or the correct liability? And then presentation and disclosure, again, together with classification, very similar. Has it gone to the right account name and number, and has it been correctly disclosed in the financial statements? Okay. Now, professional skepticism is something that is important to auditors. Professional skepticism is basically talking about the fact that the auditor does not take for granted what the directors are telling him. The auditor always has a questioning mind during the audit. Why is that important? Professional skepticism is important because the auditor is likely to be lied to if management is fraudulent. And as a result, as auditors, we don't want to be misled. We want rather to question what management is telling us. We want to inquire and dig deeper so that we understand what management is attempting to tell us. And so that's why having professional skepticism or a questioning mind is very important for the auditor. Next is professional judgment. Professional judgment is talking about the fact that an auditor may need to make certain decisions during his audit. Auditor may need to make certain decisions during his audit. And therefore, as a result, the auditor has to have made a decision that other people in a similar position would have made. And that's what professional judgment is talking about. Professional judgment is talking about making a measured and a calculated decision, not making a poor decision. Okay? So professional judgment also is very important to auditors. Now let's look at the postulates. Now many people mispronounce this. It's pronounced postulates and nothing else. Okay. A postulate is a way of thinking. It's a paradigm of thinking. It's a way to look into the world. So, for example, you may say, "I am a positive person." Your postulate is an optimistic postulate. Okay? It is something that you always think of the best of everyone and everything. That is a postulate. It is the way you position yourself when you think about something. Okay? And so auditing has postulates. There are certain things in auditing that will not function if we don't view it in a specific way. Okay, so now let's look at the auditing postulates. Okay, I have an acronym for you, and the acronym is as follows. You can insert whatever boy's name here. Let's say Jim. Jim has spice, thus he has 5 girlfriends. That's our acronym. Jim has spice, thus he has 5 girlfriends. So let's have a look at our acronym. First, the first one, the auditing profession has a specific status. That's what the S is for. Auditing profession has a specific status in the company, in the country, in general. And therefore, we need to meet that status by making sure we don't bring the status down. We need to improve ourselves until we are meeting and exceeding that status. Okay? So that's the first one. The auditing profession has a high status. Now, why is that important? Why is that postulate important? Because if we did not have a high status and people did not trust us, then whatever we said about the financial statements will not hold credibility. So without a high level or high professional status, the credibility of the opinions that auditors give then are meaningless. Okay, so if people don't trust auditors, then the entire auditing profession is useless and should shut down. So our status is very important. The next thing that's very important is that whatever has happened in the past should happen in the future. Now, we must treat this postulate with a lot of professional skepticism. Okay, we're just speaking about professional skepticism. We must treat this postulate very suspect, because it's okay to accept in general that things, that trends repeat themselves, but we should not hold to it too tightly and look for specifics, look for details, and expect details to repeat themselves. That is not going to happen. Okay, but what the postulate is basically saying is that whatever has happened in the past should hold true in the future. I is saying that the internal controls that are in place at the client should reduce errors and frauds or irregularities. Okay, internal controls, like we said in part 1, are activities that management does in order to reduce the risk of error or fraud. Now, our postulate, the auditing postulate, is saying we must believe that it actually works. We must believe that the internal control actually works. Okay? So we're saying the internal control reduces the probability of fraud taking place. Okay? Fraud or errors taking place. This is important because if we cannot trust the internal controls, it means that we won't be able to give a reasonable assurance. Right? Remember, reasonable assurance is issued even though we do not test every single journal entry in a company. Right? Remember what we spoke about in part 1? We said auditor can give reasonable assurance without testing every single journal entry in a company, and the reason for that is because we are believing that the internal control that management has put in place is also verifying, is also checking, in a sense, auditing the transactions that are coming. Right? So auditor is considered to be a secondary assurance or secondary check on the financial statements. Right? So we have to, as auditors, believe that the internal controls work. The next is there is no conflict between what the auditor wants and what management wants. Okay? Now this is an important one, because we must believe that management wants a clean set of financial statements. We must believe that management does not want to commit fraud. We must believe that management wants to be ethical, because if we do not, it makes it impossible for us to test if management has committed fraud. Remember, management is in control of the financial statements, as well as the data that goes into the financial statements, as well as the internal controls that create that data that goes into the financial statements. So if management wanted to collude or do something illegal, they can change everything along that line, which will make it impossible for the auditor to detect any fraud. So we have to believe that management is ethical and wants to do what is right. The next is that the auditor is only acting in his capacity as auditor and only wants to give a, a independent opinion of the financial statements. So this is important because what we often find out in practice is that the auditor is then required to do things like tax work. The auditor is required to compile financial statements and audit them, and this is not correct. The auditor should not be allowed to do any other work except audit, because then he loses this independence. So this one is saying he's acting exclusively as an auditor. He's acting only as an auditor. He's not acting as an auditor and a preparer of financial statements. He's not acting as an auditor and a tax advisor. He's only the auditor of this firm. Right, so that's important. If we don't believe that the auditor is acting only as the auditor of the firm, it becomes very difficult for the shareholders to trust the auditor. Okay, so far we did SPICE. Now let's do 5. The next is financial data, or the data that we are trying to audit, is somehow verifiable. We can somehow test or check that it is correct, right? And there's a right and there's a wrong, right? So that's what we're hoping for. Financial data is somehow verifiable. The next is that the application of accounting principles are fair. Application of accounting principles result in fair presentation of the financial statements, right? So that's what we're hoping. We're hoping that if management follows everything in the IFRS to the T, whatever they come out with should be fairly representing the state of the company. Okay, so we need to trust that the IFRS board has actually issued the correct standard. That's what we're saying here. We should trust that accounting and IFRS has been doing things correctly. The next is we need to accept that the financial statements do not include any collusion. Like we mentioned before, if there is collusion, it is extremely difficult for the auditor to detect. And as a result, the auditor will be hard pressed, or it might even be impossible for the auditor to detect collusion in financial statements. Okay, so what did we learn in these 2 sessions? The first is that the auditing profession provides credibility for financial statements. That credibility is used then by shareholders, by government, by users of the financial statements to make future decisions. Those future decisions are the same decisions that build and grow and nourish our economy. So without the auditor giving credibility to financial statements, the economy starts to break down slowly. Okay, so the auditor is very important. The next thing that we learned is what is an auditor. An auditor is someone that gives some form of assurance. Why do we need auditors? To offer some sort of credibility. We then spoke about assurance and non-assurance engagements. Remember, assurance engagements is where there's an opinion, right? And there may be different types of opinion. So we may give reasonable assurance or limited assurance, but there's always an opinion given. Whereas in non-assurance, we either present management with the results of our tests, or we gather and group information for management, but we're not issuing an opinion. Okay. Now the two important ones that are highlighted here are the PI score for this week is very important. We must be comfortable with the PI score, as well as application of the assertions, right? So we don't just want to know the definition of the assertions, we want to be able to apply the assertions. Very important. Okay, thanks guys for today's lecture and part 2 of the introduction to auditing 3A. I hope to see you next time in class as opposed to here on video. And I would also like to encourage you to read chapter 1 again after having watched these lectures. Go through chapter 1 in detail and then attempt your tutorials afterward. Anyway, thank you. Bye bye.